we're starting to see things changing rapidly. It's being reflected in the local currency, and we're seeing a bit of rotation out of certain equities into rand hedges. It's something that's starting to become more evident and more pronounced right now. Let's delve into equities as an asset class right now, and what your sense is. Should we be underweight or overweight at this point?
Hi Eleni, Atlantic Asset Management is a fixed income only house, but we do have the real income product that can allocate up to 25% in equity. So it's tough for us to speak to the equity sector or the equity market with a broad stroke. But I think specifically those equities that are impacted by inflation, both on the up and the downside, we're clearly now into a sector rotation mode again, where as you highlight, the rand hedges will be coming to the fore. I think also specifically in the precious metals area, there's definitely some plays. And maybe also on the food side, I mean, we keep on jumping between food producers and more on the retail side. So there's definitely some opportunities, but I do think that the risk is on the financial and the retail side. We've seen some moves there of late, although those are stocks that we don't follow too closely.
Well, I mean, on the equity front, we know that if there is a significant slowdown coming through in the developed world, that it will impact a lot of our companies and all the stocks that are on the JSE. We know that the resource sector could be the most sensitive sector at this point in time, despite the fact that we've seen commodity prices maintaining ground. With regards to actual sectors right now, which would you say is the safest at this point, Erik?
At this stage, and I'm going to contradict myself slightly now, at this stage it's actually very important for us to look at those companies that we follow closest and find the stories in there that's probably going to benefit from a lower for longer type of inflation, interest rate environment with the risk of inflation and a currency overlay and definitely lower growth. Now, that's a very tricky economic backdrop for equities in general. I think our view at the moment is that, broadly speaking, equities have again, traded quite aggressively to the upside over the last few days. So, of late, we've actually made use of this bounce to reduce our exposure to equities in general. But assets in South Africa in general is actually looking quite expensive at present. And those guys that do have the luxury of an offshore component to their investment process is probably benefiting. So really for us now, on the equity side, it's really those counters that are mostly impacted by a softer rand that we'll look at.
Well, let's look at inflation-linked bonds versus actual bond exposure. At this point, it seems that inflation-linked bonds have been the favorite, at least over the last few months. We know that inflation picture is changing quite rapidly, although inflation remained unchanged at 5.5% year on year for the month of August. What is your sense now, Erik? Are they looking expensive? Are they looking cheap? Where are you finding value?
This is really a call, short-term call versus a longer-term call. I think we're probably leaning slightly more towards the nominal side than the real side, although we'll argue that the real side is more a function of break-evens at the moment. So one should be very careful to be too aggressive on calling interest rate cuts in South Africa when we're already running, the CPI today printing at 5.3, so very close to negative real repo at present. And although the SARB would try to be as accommodative as possible and be happy with real interest rates around the 0% level relative to their average of 2 or slightly above 2 in other cycles, our inclination is that over the longer term, compared to where real rates are on a global basis, the 2.5 to 2.3% level on inflation-linked bonds is not that high. But in this recent sell-off in the nominal yields, there are probably, on a total return basis, in the short term, better opportunities.
So, Erik, also just looking at what your favorite asset class is right now, we know that we've left out the likes of property as well. Of all the asset classes, what are you looking at right now as the safest place to be?
Well, given what's happening, especially in Europe at present, and it's absolutely amazing to see the lack of of drive from Germany, especially to sort out the problems we're experiencing in Greece still. Cash is probably the most attractive asset. It's just to figure out what part of cash is the most attractive, because if things get worse in Europe, we may go back into a 28 scenario where liquidity was a very, very big issue. So return of your money is probably more important than return on your money. From where we're standing at present, and we discussed this on the show a couple of months ago, my favorite trade year to date has actually been along the 3-year NCD, and that was really in acknowledgement of lower for longer interest rates around the world, and slide plays a very important role in that regard. So you'll see the likes of PIMCO, etc., being very excited about the 3 to 5 years, so the belly part of an interest rate curve. And I think the same holds for South Africa as well. If you like credit, and credit is probably slightly at risk, if there's a very big overlay to Giokos, so big pickup and credit names that you're happy with, that's probably also a space to look at. But in a worst case scenario, South Africa can move into an environment where it cuts rates between 100 and maybe 200-300 points if the rand starts going, and in that environment, floating rate exposure could be problematic.